Welcome to Taking Stock. I'm Amanda Lang. Coming up on the show, what happened to dropping internal trade barriers in Canada? And are we losing jobs to AI already? Plus, what it really costs to live in this country. It's well above the minimum wage. That's all ahead. First, for the week that was in business, it's time for the briefs. The latest targets for the Major Projects Office have been announced. The list of new projects includes some familiar ones, including mines, LNG in BC, and a hydro project in the north. The recent budget allocated $213 million in spending for the office over the next 5 years. It also proposed to make it a standalone entity rather than a department of the government. Canadian artificial intelligence firm Clio is now valued at $5 billion U.S. based on its latest round of funding. The provider of legal AI technology also completed its acquisition of VLEX for $1 billion U.S. Clio's new capital includes equity from Goldman Sachs and a debt facility led by Blackstone. Visa and MasterCard have reached a settlement in the U.S. with merchants who accused them of overcharging for the use of the cards. Under the agreement, the card companies would agree to slightly lower fees, but also allow merchants to reject cards that carry a higher transaction cost. Thousands of flights were canceled across the U.S. this week as the Federal Aviation Administration limited capacity for safety reasons at 40 airports. The record-long government shutdown in the U.S. meant air traffic controllers were not being paid. An agreement to reopen the U.S. government this week may still take days or weeks to implement. The International Energy Agency said this week that global oil consumption is expected to keep growing until 2050, but that the rapid rise of renewable energy will also mean a transition is inevitable. Supply of renewables will grow faster than any other energy source over the next decade, according to the IEA. Loblaws reported a solid quarter this week with sales up 4.6% as traffic grew and shoppers spent more per visit. Loblaws discount brands outperformed its full-price grocery stores as shoppers continued to hunt for bargains. And those are your business briefs. Internal trade barriers were supposed to come down between provinces as part of our Team Canada efforts. But when it comes to booze, at least, plenty of barriers remain. Dan Kelly is president and CEO of the Canadian Federation of Independent Business. Dan, great to see you.
Good to be with you.
So you guys have actually done a study on this. This is not new, but obviously what's not happening is that these existing barriers, and alcohol is one place where they've been really high, are still in place. What do you make of this?
Look, there's been a lot of hustle on the internal trade barrier file, more than I've seen in the 31 years I've been working in public policy. But still, we have such a long way to go. And I'm not sure that governments are moving beyond platitudes and commitments into action. And that's what's really needed here. We've had governments in 2017, there was an agreement to move on alcohol rules across Canada. And only now are we starting to see some fruits of that labor with some direct consumer plans in the years ahead.
So when obviously it feels as though there's never been a better moment to break down some of these barriers, do they take time? Even once the will is there, could it be in process, but it takes months and months to actually remove regulations that are sitting there?
That's just it. I think the political will is there, but they've been fumbling around in actually getting it into practice. And that's because there's, of course, a patchwork quilt of agencies involved. The challenge, of course, is especially true for liquor. We have about 10 different problems that we have to solve here. Some provinces have their own testing requirements where all alcohol products have to be tested by that province. Some have different labeling requirements, so you have to slap on different labels depending on where it's going. And then, of course, you actually, in most cases, have to sell your products as a small producer of wine, beer, or spirits to the liquor authority, the provincial liquor authority, who then distributes it to consumers or to retail. And so we have all of those agencies that have to turn their keys. And that's why this has been a real challenge to make serious progress, despite political commitments on the part of many governments.
And, you know, we have heard talk at the federal level about trying to facilitate and get rid of any of the interprovincial trade barriers that belong to them. Is this a good example of where most of them actually are at the provincial and even the municipal level, but that at the provincial level is where most of these barriers live? It doesn't really matter what the federal government says if the provinces don't get on board. And I'm guessing, Dan, if they don't all get on board, it's really easy for a province to say, well, then I'm not going to send my liquor, let your liquor come in here. I mean, it does have to be kind of a shared thing.
That's just it. In fact, to be fair to the feds, they have moved. They did have some rules that restricted interprovincial trade that they have since scrapped. So the feds actually have done, I think, their part of this, and it's now the provinces that unfortunately still have many of these policies in shape. But some of them are pretty big hurdles. One of the reasons why this has been so slow is that provinces derive a huge revenue stream from the sale, like being the intermediary between the producer and the consumer,
Right.
and they're loath to give that up. So ultimately, the model that I think has been agreed to is that we're going to allow private producers to sell directly to consumers, regardless of where they are in Canada. But to do that, the producers have to go through a labyrinth of process steps to try to make that happen and still ensure that the province gets its cut along the way. It's far simpler with sales taxes. We've largely figured that out, that if you're selling things between provinces, the local sales tax rate is applied. But there's so many more intermediaries in this process and all sorts of additional regulations that makes it much, much harder.
Dan, so good to have you with us. Appreciate your time today.
Anytime at all.
Dan Kelly is President and CEO of the Canadian Federation of Independent Business. Up next, when it comes to your job, is the future friendly? Stay with us. Welcome back. Despite a resilient job market, there are still fears of workers being displaced by technology. Here's a look by the numbers. First, the good news. Canada added a surprising 67,000 jobs in October. The unemployment rate dropped to 6.9%. Both full and part-time work rose on an annual basis, but the bulk of the jobs came from sales of goods. Wholesale and retail trade added 41,000 jobs. Meanwhile, construction was lower, with 15,000 jobs lost. In fact, work in construction and manufacturing are both down between January and October, while service sector employment gained 142,000 jobs at the same time. And for all the fear about AI taking our jobs, so far in Canada that hasn't been the effect. 60% of jobs are highly exposed to AI-related changes, but for businesses using AI, 89% say there's been no change in their employment plans. That story is different in the U.S. Employers there announced 153,000 job cuts in October. That's a 175% gain from October 2024 and 183% above the month prior. Cost cutting was the top reason cited for layoffs in October. AI, the second most cited factor, accounting for 48,414 job cuts so far this year. John Challenger is CEO of Challenger Gray, and Christmas has recently recorded that big jump in U.S. layoffs. I spoke with Challenger and started by asking him if the numbers were a surprise to him.
In some ways, yes, because we hadn't seen a big breakout month, but we had seen layoffs increasing this year significantly over last year. We just hadn't seen these big mega layoffs that all of a sudden happened for the first time since 2020 in the month of October.
I also asked Challenger how much of the job softness is about tariffs and a slowdown still to come.
I think that's the number one factor. The economy is slowing. Companies are now restructuring. Companies in every industry that weren't doing well vis-a-vis their competitors are making cuts and having to go through this cost cutting. But certainly it's not the only factor that we're seeing that's driving these heavy cuts right now.
Challenger has been reporting on jobs for a long time. I asked him if this period is reminiscent of previous tech adoption and its impact on jobs.
I don't think I've ever seen something quite like AI in terms of its potential impact, on workers. Maybe, some of what we saw in the 80s and 90s in manufacturing, not just because of robotics, which is in fact something that was mentioned here. We saw big, heavy cuts in early 2000s because of the dot-com layoffs, but that wasn't a new technology changing the way work was organized. It was just those companies grew so fast that when the air was let out of that bubble, we saw a lot of job cuts. This really is different. It's leading to a kind of a fundamental restructuring of how work's done for many kinds of jobs, both blue collar and white collar.
Previous tech shifts did kill some jobs, but created others. And I asked Challenger if that will be true with AI.
I do believe, certainly longer term, that is what happens. Every time there's new technology, there are jobs that are lost as the world moves to the new paradigm, the economy moves to a new paradigm. But it doesn't happen instantly. And that's where the difficulty lies. The people who lose their jobs have a hard time finding their way into the jobs of the future. And those jobs of the future don't emerge right away. It takes time.
There's a fear that AI will be different and that some jobs will disappear outright and some workers be cut out of the market altogether.
I think that that's the more likely story. The next era will be based on who knows what kinds of companies and what kind of productivity emerges because of this tool. AI might be the greatest tool, maybe since the wheel or something like that, ever invented. And it's going to have enormous impact on the kinds of new kinds of companies, offerings, say medical technology. We don't know yet. So I do think it's going to spur the economy long term. It's going to define the next era. We just don't know where those jobs are yet.
Job markets move in cycles. I asked Challenger how resilient the job market in the U.S. feels to him.
Well, isn't that interesting? Because we're talking about, the two forces, one that could drive the economy forward and keep it from being too deep of a recession, AI, and then also then just the kind of the slowdown. We've been through a long up cycle. Economies go through cycles, and we do seem to be on the downside of that cycle. Global affairs certainly are making all of the freedom that created and greased the wheels of the global economy. That seems to be getting much more tight. So I do think we're likely headed towards recession, and yet the thing that's causing layoffs, the second biggest force, is the saving grace. If this recession isn't too deep or we avoid it, it'll probably be because of all the investment in AI.
That was John Challenger, CEO of Challenger Gray and Christmas. In Canada, jobs are holding on, but the economy is also facing some pending job losses in the public sector. Jim Stanford is director of the Centre for Future Work. Jim, thanks for being with us.
My pleasure, Amanda.
So, it's interesting. Governments are often measured, their success is measured on job creation. This one is, of course, announcing public sector cuts, which in a certain way sounds, okay, we're right-sizing government. Those are tens of thousands of very high-quality jobs. Are we worried at all about the effect that will have on the economy?
Oh, certainly. That will have a bit of a drag on the overall labor market. They're trying to downsize the federal public service by about 40,000 positions over the next 3 or 4 years. Some of those cuts have already happened, actually. Some of the others will happen via retirement incentives and other voluntary measures, but it still means fewer people are working, and that is the last thing Canada's economy needs right now.
And we've been having this conversation about the role that technology will play in future layoffs. You and I have talked about this in the past. Not everybody is as gloomy as some about, that AI will displace everything. But it does feel, Jim, that we're seeing increasingly companies are seeing some cost savings here and that, fewer people can do the same work. This is the name of the game with technology. How worried do we need to be?
Well, there's so many different things happening with AI, Amanda. On a net basis, I think so far it has created more jobs than it has destroyed, but mostly via this enormous boom, you might even say bubble, in AI-related investments, including the programming and everything, but also the data centers and the power sources and so on. I think we're maybe seeing the beginnings of some changes in labor demand where AI is being used instead of staff. Mostly in terms of slow hiring. We haven't seen big AI-related layoffs, but I think we are seeing a tendency for less people being hired at the entry level in the labor market, and that could be related to companies saying, you know what, I don't actually need those new people. I can do it with technology instead. So many things happening there. I'm not predicting the end of work. That's definitely not going to happen. But there will be some disruptions and shifts in how the labor market works, no doubt about it.
So on that front, there is this prospect that companies will become ever more profitable, but with fewer workers. But we've been facing that prospect for really decades in a way, but certainly the last decade. You're not overly worried about that, or do we have the policies in place to meet it if it does happen?
I don't think we have adequate policies. So we have seen growing inequality. We've seen an amazing concentration of wealth in that AI sector. Just look at the makeup of the stock market valuations these days. And you know that billionaires are collecting that wealth. Canada's richest person is now a crypto billionaire who was pardoned from jail by Donald Trump. So that tells you that this tendency towards concentration and oligarchy, if you like, will come to Canada as well. And I do think we need stronger redistributive policies to make sure these billionaires pay more tax, and that other Canadians are supported, both in work through stronger wages and working conditions, but those out of work through good income support benefits.
We don't have a ton of time, just a few seconds, but on that front, the government is trying to cut costs, but it's also taking on debt. Are you worried about the fiscal ability to meet some of these challenges?
Given how the world is unfolding, and given that Canada's in a fight for its future right now, that really is well down the list of priorities. Canada's debt is small by international standards, and if we're using that debt to finance a stronger economy that can stand up to Trump, it's a good decision.
Jim, always good to have your thoughts. Appreciate your time.
Thank you.
Jim Stanford is director of the Centre for Future Work. Coming up, the federal budget included efforts to kickstart investments in Canada. Will it work? That's still ahead. But first, PayPal is expanding its buy now, pay later service here, adding itself to several other options in the market in Canada. PayPal will partner with companies like the Home Depot and Ticketmaster to offer installment plans of 4 interest-free payments over 6 weeks. And it's true, it's all good if you're good on your debt. If not, watch out for the late fees. We're back after this. Welcome back. The federal budget included $750 million aimed at supporting entrepreneurs and the networks that fund them. It's something people working in that space have lobbied hard for. Claudia Rojas is CEO of the National Angel Capital Organization. Claudia, thanks for being with us.
Thanks, Amanda.
And I think you were pretty happy with some of the measures that you saw. So let's start with what you did see that you like in the budget and what it might do for startup capital in the country.
What I think is very important to recognize is that Budget 2025 is a critical step forward for our innovation economy. We've talked for many years about the importance of capital and networks for our entrepreneurs so that they can have access to the resources that they need to scale their companies. And Budget 2025 signaled that this is a high priority for this government.
And so how do we put the money to work? Obviously, one of the big issues we have in Canada is capital that allows innovations to stay here. Is that just as true at the smallest level, the startup level, as it is at the midsize? We've got a big problem at the midsize, Claudio, but you're focused on the early stage. Do companies stay when they can get capital here?
So having access to capital is really critical across all stages of the innovation pipeline. And so when we look at these later stage companies and we ask why don't we have more, or why are we seeing early acquisitions, really the answer is what are we doing at the earliest stage? And so we have data to support this. And so companies that are able to access deep pools of capital early and on an accelerated basis, they're much more competitive as they move into later stages of funding and as they approach IPO. So this is really critical. The $750 million investment into establishing national infrastructure, capital, and networks, what it will do is create many more access points to capital for entrepreneurs at the early stage so that they can grow into the multi-billion-dollar companies of the future. And what's important there is not just the capital, but it's also the resources, the intellectual knowledge, the domain expertise, the broader access to clients that angel investors bring to their portfolio companies.
You know, angel investors come by that name for a reason. There's some faith in that process, right? There's a belief in the idea that you join in on. Governments can do a good job of that too, because they've got deep pockets, they can afford the risk. Do we do a good job, once you've grown these things, Claudia, of getting the big investors of this country? I'm thinking of the pension funds, but other big private pools of capital in this country involved in making sure that Canadian innovations actually stay Canadian?
Private pools of capital, we believe, will mobilize at a much greater scale going forward as we fill this early stage of the pipeline with high potential companies, with companies that will dominate in areas like artificial intelligence, quantum, clean technologies, digital health. And so it's our collective responsibility to create the conditions for private capital to mobilize at scale. And what we will see and what we have seen is that our entrepreneurs are world class. They have been building companies in adverse conditions. And despite that, despite the infrastructure at the early stage needing further development, which it now will be able to with the $750 million commitment, we've still produced Cohere, a $5 billion success story. Wealthsimple, who was funded by our Angel Investor of the Year with a $250,000 check, and they're now worth $10 billion. Shopify, also funded from angel investors, another $250,000 check, and a $250 billion company. So the more of these companies that are moving through the innovation pipeline at the earliest stage, the more companies we'll have at the later stage for the pension funds to invest in.
Was there anything you didn't see in the budget that you hoped to?
A national investment tax credit is exceptionally important for mobilizing private capital at scale. It corrects for the very high risk at the early stage, at that first check level. We've seen this in other jurisdictions. A report that we published looked at peer jurisdictions that have leveraged and mobilized private capital at scale using a national investment tax credit. And we're hopeful that in addition to establishing capital and networks, so 21st century infrastructure for a 21st century economy, we'll also see a national investment tax credit to mobilize more private capital into the ecosystem.
All right, stay tuned for that. Claudio, great to have you with us.
Thanks, Amanda.
Claudio Rojas is CEO of the National Angel Capital Organization. Time for the takeaway and what bare minimum feels like. Across Canada, the lowest legal wage rose this year, though the amount ranges by province from a high of $19.75 an hour in Nunavut to Alberta's $15 an hour. The principle is the same, to set a floor under what a worker can be paid. It's a form of protection designed to keep workers from being exploited, especially in jobs with plenty of churn, where one worker could be replaced easily with another. And it's intended to be a reflection, at least in part, on the cost of living. But here's where things start to go sideways. According to the Ontario Living Wage Network, the gap between that minimum wage pay and what it actually costs to get by is growing. In Ontario, the living wage, what you actually need to earn per hour to live in that place, ranges from $21 an hour to a high of $27.20 in the city of Toronto. And it's up sharply across the province, including jumps in places like Guelph and Waterloo of 8% compared to 2024. So what do we make of the fact that workers are guaranteed a wage that won't guarantee them a life? For one thing, the cost of living is being distorted by the high cost of housing in Canada. While rents have softened slightly, they're still high relative to a few years ago. Other costs, like food and transportation, are still elevated, although childcare costs in the form of universal daycare could take some pressure off of families. But the question we have to ask is, why have a minimum wage if it's not a livable one? Some employers push back on wage floors, arguing that there's a group of workers, including part-time and younger ones, who can afford to earn less per hour in exchange for flexibility or to earn their stripes and experience. And maybe that's true for some component of the workforce, but the minimum wage law may have an unintended consequence of letting employers stop at that number, as though it's a government-sanctioned amount. If the market was functioning properly, workers in high-cost locations would naturally demand and receive higher pay. That it doesn't happen suggests there's something flawed in our system. My takeaway? We've already agreed workers deserve protection from exploitation, but there's more work to be done on what happens after that. That's Taking Stock for this week. I'm Amanda Lang. Thanks for being with us.